How do you develop a stock screen to identify undervalued financial firms? Well, maybe the first question you want to ask is, why would you want to include financial firms in your portfolio? Actually, financial firms are a very important part of the stock market. If you just take a look at the S&P 500 index, as of 2019, 67 out of the 500 firms in the index were in the financial sector. And if you look at their market value, financial firms basically accounted for 13.3% of the overall market value of the index. In other words, this is not a segment of the market that you really can afford to ignore. Otherwise, you're not going to get the proper diversification that you need. Well, in order to understand how we develop effective screening criteria to identify undervalued financials, we have to understand why financials are different. So just a little recap associated with this. These firms really are different if you think about financial firms in the traditional sense, like a commercial bank. One of the major differences is that their capital structure is different. They use debt as a raw material. They also have different CapEx. They have large spending on intangible assets, but in terms of their overall net worth, not as much is put into property, plant, and equipment. So you've got a cash flow statement that shows a little depreciation and little capital expenditures. And their working capital is very large as a percentage of the balance sheet. They're also highly regulated. So these firms really are quite different. And I want to share with you some ideas on how to develop an equity screen for financials. First, let me go to just Capital IQ. And what I'm going to do is blow this up a little bit. And what we can do is do screening. Let's go do an equity screen. And let's add in the first criterion is just put in major US exchanges. We can add that to our screen. Then what we can do is go to an industry classification. And we can just focus on financials. Obviously, there are different types of financials, but that would actually be enough right there to get us going. So this should reduce it down quite a bit, right? I mean, it drops it from over 6,000 firms to just 2,297 that we've selected. So what are some ideas for actually identifying undervalued financials? Let me share some of these with you. First of all, we've done this industry classification, but second, there are a lot of industry-specific items that you can do a screen on. And I mentioned a number of them here. One of them is net interest income. A traditional bank makes money off that difference between the amount they charge on their loans. Loans are assets for banks, remember, and basically what it costs them to borrow money. And if you think about interest-bearing deposits, that may be an asset for you, but it's a liability for a bank. For example, a checking account. My personal checking account is an asset for me, but it's a liability for the bank because whenever I write a check, they have to actually make good on those funds. So the difference between those, the return on the assets and the cost of funds, is that net interest income. And you could look at that as a percentage of total revenues. Obviously, you would want something higher. So let's take a look at that. How do you actually get to that in Capital IQ? Well, under most used, you can see here I have industry specific financials. And what I would like to do is just focus on, let's take a look at bank specific. In the income statement, you've got a lot of these here. You've got things under supplemental as well. But this is the one that I was really focusing on, that net interest income as a percent of total revenues. You could actually do it relative to other firms as well. Like have it in the first decile. I mean, I think that's a great idea for the screen. Another is non-performing loans. Non-performing loans are those that obviously aren't getting payments. You want that to be low, so you could put it as a percent of total loans or total assets. So that's really a risk measure. You could also look at the growth as well in things like interest income, loans, and other things as well. So let's take a look at some of those. I'm going to collapse these and then take a look at growth rates. You may want to see that net interest income growing over several years. You can also take a look at the provision for loan losses. And you wouldn't want to see non-performing assets growing, right? So you could try and get a low growth rate for this. If you're looking for a financial institution that's growing, you could also just put in a high growth rate for total deposits. That would be another way to get at that. So under the second bullet point, there are lots of industry-specific financials that you could put in. Another idea has to do with ROE. And remember, the reason why I'm really discussing this is because I want to give you an application of that residual income model. Residual income is the same thing as excess returns, and financials are just a great way to apply that model. There are a number of ways that you can calculate residual income, and you see the formula at the bottom of this slide shows that it's really the difference between ROE and cost of equity times the beginning book value. So ROE is very important here, and related to that, you could actually screen on ROE. In order for a financial institution to generate excess returns, they would need to have a high and hopefully stable ROE. So you can put that into a screen as well. And the way that you do that is just type that into the search bar. And you can get a number of ROE numbers up here. You can get it in, you can have it greater than a certain amount. The rule of thumb is that large banks generally should earn a return on equity above 10%, and you could screen for that for the last 12 months, the last 12 months 2 years back or 3 years back. So you could add multiple criterion here in order to get a return on equity over several years that was high. So I think that that's a great idea. Another is the dividend yield. Financial institutions often pay off a high dividend yield. You may want to look at that. And another idea is that price to book ratio. The way the assets are accounted for on the balance sheet of a bank is that they're more likely to be put on the balance sheet at market value. So this book value actually has much more significance for financial institutions, and that price to book ratio tends to be much more effective as a multiple in terms of computing the intrinsic value. So those are my ideas for developing an equity screen. I'm not going to go through them all, so I wanted to give you just enough to get the wheels turning in your head so that you can think about how to actually implement this. And you start off with exchanges and the industry classification, and then there's a lot of ways that you can go to identify undervalued financial firms. Hope that helps.